Hi guys, welcome to part 2 of the investing in derivatives in Kenya video. And if you can remember, in part 1, I introduced the concept of derivatives and gave you a few advantages of investing in the derivatives market. So in this video, that's part 2 of this series, I want to show you guys how you can make a profit in the derivatives market in Kenya. But before that, it's important that we introduce some concepts. So I'll be introducing the concept of futures contracts. Remember I mentioned that we only have futures contracts in our local market. So first we'll define what a futures contract is. Then I'll talk about the expiry of futures contracts. Then I'll talk about the concept of margin. And then I'll also talk about how you can take a long or a short position and how you can use these two positions to make a profit in the market. And finally, I'll use a sample client statement just to illustrate the concepts that I've explained. Just a reminder guys, if you've not watched part 1 of the video, go back and watch that video because that's where I introduced the concept of derivatives. What is a futures contract? A futures contract is a contractual agreement between two people to buy or sell a particular asset at a predetermined price at a specified time in the future. Don't focus a lot on the definitions because all these concepts will become more clear when I show you the examples. Just a reminder, currently we have futures contracts for 10 key NSE stocks. That's Safaricom, Equity, KCB, ABSA, NCBA, Coop Bank, I&M Bank, EABL, Stanchart, and BAT. Let's now talk about the expiry of futures contracts. Please know that in our markets, futures contracts expire after every 3 months. That is March, June, September, and December. On every third Thursday of the expiry months, all open futures positions are closed out and settled at the current spot price of the underlying stocks. This means that if on the expiry date, Safaricom closes at 14 bob, the equivalent Safaricom futures will also be settled at 14 bob. Let's now talk about the naming of futures contracts. And I want you guys to focus on your screen. As you can see, the futures contracts are named using the expiry date and the name of the underlying stock. So we have 21 December, so that's the 21st of December 2023, and the underlying stock is Safaricom. We also have 21st of March 2024, and the underlying stock is Safaricom. From a layman's perspective, if you entered into any of these contracts today, that's October of 2023, you're basically trying to speculate on where the price of the underlying stock, that's Safaricom in this case, will be on the date of expiry. That is, where will the price of Safaricom be on the 21st of December 2023? Or where will the price of Safaricom be on the 21st of March 2024? Let me now introduce the concept of margin. I defined margin in part 1 of this series, so if you don't know the definition of margin, refer to that video. In our local futures market, one contract represents 1,000 underlying shares. That's for stocks that are trading below 100 Kenyan shillings, the likes of Safaricom, KCB, ABSA, etc. On the other hand, one contract represents 100 underlying shares for stocks trading above 100 Kenyan shillings, the likes of BAT and EABL. This means that for a stock like Safaricom, which is currently trading at 14 Kenyan shillings, one futures contract of Safaricom will be worth 14, that's the price, times 1, that's the number of contracts, times 1,000. That's 14,000, which will be the total value of the contract. On the other hand, EABL, which is currently trading at 130, the total value of one contract will be 130, that's the price, times 1, that's the number of contracts, times 100. So that's 130 times 1 times 100. So that's 13,000 Kenyan shillings, which is the value of that contract. This is where the concept of margin comes in. Unlike in the spot market, where you need the entire 14,000 Kenyan shillings to buy 1,000 shares of Safaricom, in this case, you only need a small amount upfront called margin to take up a contract with the same value, that is 14,000 Kenyan shillings. Let's now see how margin is calculated. Please note that you don't need to calculate this margin for yourself because the trading system automatically calculates the margin for you and shows you how many contracts you can pick up with the amount you have in the account. But it's advisable just to have an understanding of how you can calculate margin for yourself. So, how much is needed to take up one contract of the 21st of December 2023 Safaricom futures contract? You will need the margin amount, which is usually divided into two. That's initial margin and additional margin, plus the trading fees, which are 0.17% for single stock futures. So that's 0.17% of the contract value. In this case, 0.17% of 14,000. Initial margin is usually set by the NSE Next for all the futures contracts that are available in the market at the moment, while additional margin is usually 10% of the initial margin. Please refer to the table on your screen, which shows the current initial margin requirements. From the margin requirements table that you've just seen on your screen, you can see that the margin requirements to pick up one contract of the 21st of December 2023 Safaricom contract is 2,300 Kenyan shillings. So from what you've learned, the additional margin will be 10% of 2,300 Kenyan shillings. That's 230 Kenyan shillings. So the initial margin is 2,300 Kenyan shillings and the additional margin is 230 Kenyan shillings. This means that the total amount you need to pick up this contract will be 2,300, that's the initial margin, plus 230, which is the additional margin, plus the trading fees, which will be 0.17% of 14,000, which is 23.8. Basically, you need a total of 2,553.8 Kenyan shillings to pick up 21st of December 2023 Safaricom futures contract valued at a total value of 14,000 Kenyan shillings. That's what we call margin. You're spending 2,553 Kenyan shillings to pick up a contract valued at 14,000 Kenyan shillings. Let's now see how profit and loss is calculated in the market. In part 1, I introduced the concept of going long or short. So in this case, if you go long, you're going to make a profit when Safaricom goes above 14, and you're going to make a loss if Safaricom happens to go below 14. On the other hand, if you go short, you're going to make a loss if the price of Safaricom goes up, that's above 14, and you're going to make a profit if the price of Safaricom goes down, that's below 14. The image you're seeing on the screen is a screenshot of the trading board on the trading system, that's Avento. So let's go through it. Clicking on B, that's buy, means you want to go long on the contract, while clicking on sell, that's S, means you want to go short on the contract. The numbers below the prices represent the numbers of contracts available at that specific price on both ends at the moment. Please note that if you want to buy, the seller offering the best price is selling at 14.35 and has one contract placed on board for sale. On the other hand, if you want to sell, the best available buyer is looking to buy at a price of 13.95 and the number of contracts available at that price are 5. To trade instantly, you can take up contracts at the price available on board, but if you feel that the prices are not the best for you, you can add your order on board with your best price and specify the amount of contracts you want to take up. Once a willing buyer or seller comes on board at the price you put, then the trade will be executed. Please note that for you to exit the contracts, you have to take the opposite, in quotes, position of the positions that you have. So if you have a long position, for you to exit or close out that position, you'll have to take a short position or rather sell. On the other hand, if you have a short position, you'll have to take the opposite position for you to exit, that's buy. Having understood this, let's now look at two scenarios where one investor took a long position and the other investor took a short position, and let's see how they made a profit or a loss on these trades. Safaricom is currently trading at 14 Kenyan shillings today, that's October of 2023, and two investors take up the 21st of December 2023 Safaricom contracts where one takes a long position and another takes a short position. On the 21st of December 2023, that's the expiry date, the contracts expire and both positions are closed out. Let's now look at two scenarios. So scenario 1, the price of Safaricom had gone up from 14 Kenyan shillings to 20 Kenyan shillings during the expiry date. Okay, so the investor who took a long position, how would we calculate his profit or loss? So the investor who took a long position, the profit would be calculated as 20 minus 14, that's the price movement, times one contract times 1,000. So he got a profit of 6,000 Kenyan shillings. On the other hand, the investor who took a short position, his loss was calculated as 14 minus 20, that's the price movement, times one contract times 1,000, which is at 6,000 Kenyan shillings loss. Scenario 2, the price of Safaricom had fallen from 14 to 10 Kenyan shillings. So let's look at the investor who took a long position. The investor who took a long position, his loss was calculated as 10 minus 14, that's the price movement, times 1 times 1,000. Hence his loss was 4,000 Kenyan shillings. On the other hand, the investor who took a short position, his profit was calculated as 14 minus 10, that's the price movement, times 1 times 1,000. Hence his profit was 4,000 Kenyan shillings. Please know that profit and loss are calculated on a daily basis in the futures market. That's based on today's closing price minus yesterday's closing price. This amount is then credited or debited from the investor's margin account cumulatively until the investor either closes out the position or the contracts expire. This daily profit and loss is called mark-to-market margin, commonly abbreviated as MTM margin. Basically, on a day where Safaricom's price closes higher than the previous day's price, investors holding long positions will get a profit, while investors holding a short position will get a loss, and vice versa. Let's now look at a sample client statement of our client who, on the 27th of June 2023, took up 3 contracts of the 21st of September 2023 futures contracts and held them until the expiry date. As you can see on your screen, he went long on one contract of Safaricom at 18 Kenyan shillings and went short on 2 contracts of KCB at 29 Kenyan shillings. This means that he expected the price of Safaricom to go above 18 Kenyan shillings by the 21st of September 2023, while KCB's share price to go below 29 Kenyan shillings by the 21st of September 2023. Fast forward to the 21st of September 2023 when the contracts expired, all the positions were automatically closed out. The price of Safaricom was at 14.95 Kenyan shillings, while the price of KCB was at 22.30 Kenyan shillings. This means that he made a loss on Safaricom and made a profit on KCB. Let's have a look. The image below shows how his contracts, or rather open positions, were closed out. That's by taking the opposite positions to the ones he held. So in this case, he sold the Safaricom contract, which he was long on, and purchased the 2 KCB contracts where he was short. Let's now see how his profit or loss was calculated. His balance was 30,165.99 Kenyan shillings on the day he took up the 3 contracts. That's the 27th of June 2023, as you can see on your screen. So he went long one contract of Safaricom. So remember the calculations we did. So that's 14.95, that's the closing price during the expiry date, minus 18 times 1, number of contracts, times 1,000. So his loss was 3,050 Kenyan shillings. On the other hand, he shorted 2 contracts of KCB. That's 29 minus 22.30 times 2, that's the number of contracts, times 1,000. Hence, his profit was 13,400 Kenyan shillings. Hence, to calculate his total profit, we'll have to take 13,400 Kenyan shillings minus 3,050 Kenyan shillings to get a total profit of 10,350 Kenyan shillings. His trading fees were 26 Kenyan shillings and 80 cents. Hence, his net total profit would be 10,350 Kenyan shillings minus 26.80, getting a total profit of 10,323 Kenyan shillings and 20 cents. Let's now look at his total account balance on the 21st of September 2023 after the expiry of the contracts. Remember, his initial account balance was 30,165 Kenyan shillings and 99 cents, and then he got a total profit of 10,323 Kenyan shillings and 20 cents. Hence, the new account balance is 40,489 Kenyan shillings and 19 cents. As you can see on your screen, his profit and loss was calculated on a daily basis, what I earlier referred to as mark-to-market margin. I hope now you've learned how you can make a profit in the derivatives market. In addition to the single stock futures that I mentioned, we also have index futures for the NSE 25 index. This index tracks 25 key stocks in the Nairobi Securities Exchange, hence a good option if you want to speculate on the performance of the general market. As you can see on your screen, the contracts are named just like the single stock futures. The only difference comes in when calculating the contract value and the trading fees, which are 0.14% for index futures. For the NSE 25 share index futures contracts, that's N25I, one index point is equals to 100 Kenyan shillings. So the contract value of one contract of the 21st of December 2023 N25I would be 2,482 Kenyan shillings, that's the price, times 1, that's the number of contracts, times 100. Hence, you get a total contract value of 248,200 Kenyan shillings. For the mini NSE 25 share index futures contract, that's MN, one index point is equal to 10 Kenyan shillings. So the contract value of one contract of the 21st of December 25 MN would be 2,482 Kenyan shillings times 1 times 10. Hence, a total contract value of 24,820 Kenyan shillings. For margin calculations, refer to the margin requirements table previously shown on your screen. And when it comes to profit and loss, the calculations are similar to the ones we did for the single stock futures. That's the end of part 2. I hope you guys have now learned how you can make a profit in the derivatives market in Kenya. In the next video, that's part 3 of the series, I'll show you how to log in into the trading system called Avento, and basically how to navigate the system, how to take a trade, how to check your account balance, etc. Stay tuned for that.